I think most people would agree that the real estate market is slow right now, at least slower than it was during COVID. That being said, we are seeing buyers and sellers trying to get creative on how to make money in this market. Some creative transactions we can insure, others we can't. One type of transaction that has been proposed to us quite often recently is commonly referred to as a subject-to transaction. In a subject-to transaction, the title to the property is transferred to the buyer, but the mortgage on the property is not paid off. The lien remains on the property, and unlike an assumption, the buyer does not assume responsibility for payment of the mortgage. So, the seller is still responsible for the mortgage until it is paid off. When these transactions are proposed, we often find that the sellers are behind on their payments on their mortgage or are already in a pre-foreclosure process and need to get their home sold quickly. When asked why they are attempting to do a subject-to, instead of a formal assumption loan, we are sometimes told that there is an informal understanding that the buyer will pay the loan current to prevent foreclosure and then continue to make payments without the legal obligation to do so that comes with a formal assumption loan. The buyers in these situations are typically real estate investors because they can utilize the lower interest rates on the current mortgage rather than getting a new loan at the higher interest rates currently in the market and incurring loan transaction cost with a new loan. The investor buyer is typically planning on flipping the house quickly and making a profit to pay off the existing mortgage. These subject-to transactions are incredibly risky for all parties involved. Assumption loans have a risk as well, especially if the parties do not get the lender approval for the assumption loan, either because they do not want to incur lender's fees or because they know the lender will not approve of the assumption. If the lender has not approved the assumption, the lender may exercise their right to call the loan due under the due on sale clause in the deed of trust upon finding out about the sale, which then puts the buyer in a position to immediately have to pay off the mortgage on the home or be foreclosed upon. A subject-to involves that risk, plus numerous other pitfalls. The seller's credit may be hit if buyer does not make the payments, with the seller having no recourse against the buyer for failure to do so. A bankruptcy trustee could attempt to void the sale. There could be a claim by an owner or a creditor of the owner that the sale was a pretend sale, that it was in fact an illegal home equity loan. And importantly, the parties could end up in litigation regarding potential fraud and consumer protection claims. As often, the desperate sellers in these situations may not even fully understand that they are giving up title to their home to these investors who may present the sale as a foreclosure rescue. As a realtor, your duty is to your clients and to help them make informed decisions. These creative transactions can have convoluted fact patterns, making it prudent to seek the advice of the title company. In most cases, a seller who's behind on their mortgage can usually work with their lender to delay foreclosure if they are attempting to sell the home in a traditional transaction where the mortgage can be paid off at closing. And there is no reason for sellers to fall victim to these sometimes predatory foreclosure prevention offers from buyers, where the sellers may also be giving up a significant amount of equity in their homes that they would otherwise receive from a traditional sale. If there is something different in your contract than what you typically see, please confer with us. While these options are creative, they can be very risky for all parties involved. Please send your next tip of the week to tipoftheweek@allegiancetitle.com, and please think of us at your next closing. Thank you.